Hi, so welcome to the live stream today, and we want to continue with our discussion on the cash flow and look at a very simple question, but quite fundamental relating to the cash flow. And we've discussed the various principles when it comes to dealing with a cash flow statement. So we want to just jump in, take a question, and see how the treatment will be done on the cash flow statement. Then from here, we're going to be looking at various other aspects based on the kind of topics or the issues that we've received. I see some of you guys joining. You are welcome. Now, this is the final part of our cash flow discussion. In case you missed the part one, the part two, and the part three, explaining the principles on the preparation of the cash flow statement as per IAS 7. I will entreat you to check the description of this video on YouTube, and you can watch the part one, the part two, and the part three. Then you'll be able to follow through with the principles. Now, remember, when it comes to preparation of the cash flow statement, it is still the accounting standards that we are dealing with, and it is one of the single entity financial statements that we will be required to prepare in our financial reporting examination. So either we're going to have a cash flow statement asked by the examiner, or we are going to be asked to prepare the statement of profit or loss and other comprehensive income, statement of changes in equity, and the statement of financial position. So either we are going to be having these financial statement being prepared or the cash flow statement being prepared. But whatever be the case and wherever we are at, the accounting standards are going to be playing a role in relation to the way various items are going to be dealt with. So let me know. I see some of you guys joining. Give me a thumbs up on the video when you join. Share the video. Let us get many students engaged, and let's get excited into our discussion for the day. And we want to look at a question relating to the cash flow statement. Now, if you remember from the beginning of our discussion in our intro, I made mention of the fact that all our discussions will be coming in from our book on financial reporting and corporate reporting. So we want to look at a question that is going to be directly coming in from the book, and it's a very basic question, but also a bit tricky. And we want to see the way the various species acts together for us to deal with the cash flow statement. So if you have any questions or something you would want me to share my thought on, put it in the chat for me or the comment section for me. We are live on Facebook. We are live on YouTube as well. And so if there are any questions, please put them in the chat for me as we continue with our discussion for the day. I see Clark coming in. Hello. I hope you're doing well. Thanks for joining us. Zamzilu said, good day, sir. Good day, Zamzilu. And then Joseph Andor says, good evening, sir. Good evening, Joseph. Michael Ashley. Is that Ashley? Okay, I guess so. Said, good evening, Professor. Good evening. Please, I'm not a professor yet. I'm Nhyira Premium. Clark said, good evening, joining from Liberia. Thanks for joining us. Uh, Grace said, give me a thumbs up in the chat. Thank you, Grace. Abu said, good evening, sir. I am still having a problem with cash flow in the areas of the adjustment. So what is your specific question? Throw it in and let's see what we can do. Ado Jibril said, happy to meet you on this season or on this season or session, I guess. God bless you too. Thanks for joining us. Okay, so we want to jump straight up into our discussion, and I want you to pay attention carefully as we look at this particular question relating to the cash flow statement. Now, like I mentioned, we are going to take a question that is directly in our financial reporting book, and that is Cold Town. In that case, now for those of you who have our financial reporting book or our corporate reporting book, you're going to find this question in there on page 451. You're going to be finding this question there. Now, for those of you who don't have the book, we're going to be making the question available for you to get access to on our Facebook group that you can get access to, or better still, you can connect with us on Telegram. You'll be able to get access to it as well. So let's see what we have here. This is a cash flow question, and we want to see what we can do here. We have a couple of footnotes coming in. For 20 marks, the examiner said, prepare a cash flow statement for Coal Town for the year ended 31st March 20x5 in accordance with IAS 7 cash flows by the indirect method. Okay, so we're using the indirect method, which I told you is always the default way we go about. So Coal Town, we're gonna have in uh our workings coming up as always. Coal Town. Now, there are a couple of things that has to be done when it comes to dealing with the issue about the cash flow statement, and it is important for you to understand how the various things are set out. So we're going to have our workings coming in, because definitely we're going to be doing a couple of workings in relation to the question. Then we're also going to have our financial statements coming in when it comes to dealing with the issue. So Coal Town statement of cash flow, statement of cash flow for the year ended 31st March 2019, 20x9. So we're going to work with two cash columns to stay how we need to look at it. So I think our currency, it's in dollars. Let's go back to the question. Yes, three zeros up. And as always, we're going to start with cash flow from operating activities. Operating activities. And you're going to start with profit before tax, as always. Okay. So this is our financial statement. We're going to have our working slide also set up here and see the various treatments that can be done in that case. Now, I see some of you guys joining. You are welcome. Give us a thumbs up on the video. We are looking at a question on cash flow statement. If there are any questions you have, please don't hesitate. Put it in the chat for me. If there is something you would want us to cover on the stream as we really start and finish up for the August 2022 examination, don't hesitate. Put it in the chat. I want to hear from you in that case. So the first thing you want to do is to quickly look at the statement of profit or loss. Now, this is our profit before tax. That's the figure we're going to be starting with. All right. As always, we're going to be starting with a profit before tax. So we go in there and we want to get that tick coming in. Profit before tax, that's 10,200. Now, so if you remember, we mentioned that we're going to be doing the various adjustments relating to what is happening to the profit for the year. So we come with the adjustments. Now, I want you to stay with me carefully as we look at the various adjustment that has to be done to the profit. So the adjustment we're going to be starting with generally will be the issue relating to the items still that we have here. Now you can see that we have finance cost here. Can you see that? Finance cost 600. It's one of the key adjustments that we are going to be doing. What do? We're going to be adding it back. All right. So finance cost, and that is an amount of 600. So we add it back. Okay. So 600, we're going to add it back. Then that's all for the P&L accounts, because there could be some other information in the footnote. Then also you see revaluation surplus in the OCI. Okay. Now, if there is revaluation in surplus in the OCI, meaning that our workings for property non-current assets, this will be going to the debit side of the PPE accounts. Does it make sense? This will go to the debit side of the PPE account. Don't worry, we'll come back to that. Then in the statement of financial position, we are seeing note 1 and note 2 having information about that. We are seeing accumulated depreciation also there. Inventories, remember this is 2008, this is 2009. So inventory is increasing, trade receivables is increasing. Now, if all these things are increasing, they are indication that money is going out, and we'll come back to them in a moment. Then, equity shares. It appears the entity has issued some shares during the year. You can see revaluation surplus going up during the year. Retained earnings. We're going to be dealing with that so we can calculate dividend for the year, but we will come back to it. Then there is 10% convertible or 10% loan note. It has gone up by 1,000. So it means there is some issue of loan notes here that we have to deal with. I hope you're getting the idea. Then there is convertible loan note in note V, and we are seeing it that it is now nil. So probably it has been repaid, but there is note V attached to it, and we're going to be dealing with that later on. Trade payables figure is falling slightly, meaning we are making payments in that regard. Issues about tax, we're going to be preparing the income tax accounts to know what is happening in there. Negligence claim, it is in note 3, we will take it up. Warranty provision has increased, and we will deal with it as an adjustment pretty later on in our discussion. So this is the structure of the financial statement that you have. The reason is that you want to just have an idea of exactly what the heck is going on. Then you can now structure yourself up to look for the various notes that must be, or the various workings that can be done. So let's go in and let's see what we can do. So let's look at the footnotes. During the year, Town redesigned its display area in all its outlets. The previous display had cost $10 million and had been written down by 9 million. The previous display cost 10 million and had been written down by 9 million. There was an unexpected cost of 500,000 for the removal and disposal of the old areas Okay, so there is a redesign of their areas related. Now remember that information from the assets here, that information relates to the non-current assets. Okay, that information relates to the non-current asset. So the first workings we're going to churn out is to look at our non-current asset workings. That's the PPE situation. So we have our T account. Remember, we can also do the horizontal presentation of the vertical presentation, whatever be the case you want to go for. So balance brought forward will be the last year's figure, which is 80,000. Okay, so that's 80,000. We pretend to close the account, and we bring in the closing balance carry down. That is 93,500. Then let's see what's going on there for the period and the review. We were told in the note 1 that during the year, they redesigned their display outlet. The previous display had cost 10 million and had been written down by 9 million. There was unexpected cost of 500,000 for the removal and the disposal of the old display. So it means that the old display had a cost of $10 million and had been disposed of. Okay, had been disposed of. So what do? We bring it to the credit side of the PPE account, disposal. The cost, 10,000, is going to be coming here. It's going to be coming here on the credit side. Then you go to the OCI because there is an information relating to the OCI I showed you earlier. There is a revaluation stop loss here of 5,000. Now, revaluation surplus 5,000, that must come into the P&L account. But we have to look out to see what was the original cost of the asset during the period under review. Because in this question, there is accumulated depreciation separately, and there is non-current assets separately, also separate. So we have to do workings too also for depreciation So accumulated depreciation. Now, accumulated depreciation has a credit balance. So we're going to be bringing in the opening balance. We have 48,000 on the credit side of the accumulated depreciation account. So we're going to be bringing that up for the period and the review. So 48,000. So balance brought forward. That was last year's figure, 48,000. So we pretend to close the accounts up so that we can get the closing balance coming in. And that is an amount of 43,000. Okay. Now, stay with me carefully. If you realize also, we were told in the note one that the old store that had been disposed of had been written down by 9 million. Had been written down by 9 million. Had been written down by 9 million. What does that mean? It means that that is the how do we call it? That is the depreciation on that old building. So since it has been disposed of, it will be debited to the depreciation account. So disposal 9,000. Disposal 9,000. Then we need to ask ourselves in workings 3 and do profit or loss on the disposal. Profit or loss on the disposal of the old store. So how is that going to be? You just complete the double entry. Okay, so you credited the non-current asset account here with 10,000. You're going to debit the disposal of asset account with that figure. So cost of display 10,000. Then the accumulated depreciation, you debited the accumulated depreciation account with the 9,000. You're going to credit the disposal account with the depreciation on it, 9,000 for the period under review. But then if you remember in the question, we were told that an unexpected cost of 500,000 was spent on the removal. Okay, on the removal. So an unexpected cost of 500 was spent on the removal. So that double entry is cost to sell. So the double entry is that we credit our cash book. Then what is going to happen is we debit the asset disposal accounts. So cost of disposal 500. Sounds good? So we credit our cash book and debit the profit or loss on asset disposal accounts in that case. So you balance this account, and we're going to be having the profit or loss on the disposal for the period under review. And we're going to be coming into that in a moment. So what are we saying here? What we are saying here is that we are completing the double entry. The cost of the asset we disposed of was 10,000. We debited to the asset disposal account. Then we bring in the accumulated depreciation on that 9,000. And then that comes to the credit side. Then the additional cost that we incurred in the disposal is 500. So we bring that also up for the period under review. We bring that also up for the period under review. So let's continue to read, and then we're going to see what is going to be happening. Now, we are not told how much this display was disposed for. In other words, we now have the proceeds from the disposal in the context of this question. So there is nothing about the proceeds from the disposal of this question, but it means that it wasn't sold for anything. Okay, it means it wasn't sold for anything. So we will come back to that. Maybe there is no, if there is no information about proceeds from the display, then we'll balance this account. That means there was a loss technically when it comes to this particular display, but we will come back to it. And so these are the three workings that we can set up so far: the non-current asset, the accumulated depreciation situation, and then the profit or loss on the disposal of the display for the year. But let's continue to read. We go to note 2. If there are any questions, you put it in the chat for me, and I'm going to be answering it for you if there are any questions. Note 2. During the year, Cold Town revalued the carrying amount of its property upward by 5 million. Did you get that? By 5 million. The accumulated depreciation on these properties of 2 million was reset to zero. So get a language on exactly what is going on here. So they revalued their assets by 5 million. Okay. They revalue their assets by 5 million. Now, if they revalue their asset by 5 million, that was the revaluation surplus you saw in the OCI here. Here. If you realize in the OCI here, that's the 5,000 you are seeing. But then they are saying that the asset that was revalued by 5,000 had previously an accumulated depreciation of 2 million. Okay, so we are working three zeros up. So accumulated depreciation of 2,000. What does that mean? It means that really the revaluation on that particular asset is just 3,000 and not 5,000. Does it make sense? So we will go to our P&L account. Did I say P&L? Property non-current asset account, and bring in the revaluation. So we will not bring in the revaluation surplus from the OCI, but we will bring the 5,000 minus 2,000. So meaning the actual revaluation surplus on this asset was 3,000. Make sense? Because even though the valuation was 5,000, the asset had an accumulated depreciation of 2,000 and they wrote it off. Then that accumulated depreciation is going to be coming in the accumulated depreciation account for the period under review. So in the accumulated depreciation account, the revaluation part of that is going to be coming in. So there's a revaluation of 2,000. So that is going to be deducted or less for the period under review. That is going to be deducted or less for the period. So even though our revaluation surplus in the OCI is 5,000, you don't bring the 5,000. Why? Because the asset had previously had the amount of 2,000 in terms of the accumulated depreciation that had been written off. All depreciation is charged to operating expenses. Colton makes annual reserves transfer from the revaluation surplus in excess of depreciation. In excess of depreciation. And we'll come back to that part of the statement a little bit later in our discussion. We'll come back to that a little bit later. So that is that footnote also there in the notes 2 about the revaluation. In the notes 2 about the revaluation. So if there are any questions, you put it in the chat for me, and we're going to be taking your questions. Then the next thing is note IV, sorry, III. In June 2019, remember our year ended is 31st March 20X9. But there's an information here about June 2019. That means June 2019 is after the reporting date. Okay, because our reporting date is 31st March 20X9. But in this information we are about to read is June 2019. So it means it's like the event after the reporting period. So some IAS 10 situation coming up here. And so we have to establish whether it is adjusting or non-adjusting event and see what has to be done relating to it. So let's go. Colton made an out of court settlement of a negligent claim brought about by a former employee. The dispute had been in progress for 2 years, and Colton had made provisions for potential liability in each of the 2 previous years. The unprovided amount of the claim at the time of the settlement was 30,000, and this was charged to the operating expenses. And this was charged to the operating expenses. 30,000, and this was charged to the operating expenses. So the unprovided amount of claim at the time of settlement, which is in the current year ended, was 30,000, and then they expense it in the P&L account. No P, we don't have problem with that. But there is something that you have to be thinking about because we have a problem with. If you come back to the statement of financial position, stay with me here. You can see that there is negligent claim here. Let me clean the plenty lines I have here. There is negligence claim. And I want you to stay with me carefully. This is in the statement of financial position. So last year, they provided for it 120, but at the end of the year, which is the current year under review, they did not provide for it. Okay, they did not provide for it in that particular case. So what does that mean for the period in relation to what we have to do in that case? And it is under current liabilities. So last year was 120, and this year there is nothing there. Then in the P&L account also, you realize that there is no information about that. But then we are told that the issues about the claim have been put into the operating expenses. The issues about the claim have been put into the operating expenses. So let's see. I'm seeing a chart coming in. Let's see if I can pick it up. What does it say? So the carrying value, is it part of the cost of the asset? Which carrying value are you talking about? Let me know. Which carrying value is that? Let's see. You really helped me a lot. That is Pelagia. Okay, Pelagia, thanks for joining us. What else do I have? Nhyira, our best gift. Thanks so much for being there. May God illuminate and fortify you. Amen. Thank you. And that's William Nya. Joe Owusu Free says, God bless you, Nhyira. God bless you too. Joe Owusu. Okay, let's go back. If there are any specific questions, you drop me head up, and then we get excited about the discussion then. So let's continue with our discussion. So this is an adjusting event, and they had already accounted for it because at the time of settlement, they had already accounted for it. So it is not something that we're going to bother ourselves up now. Okay, we're not going to bother ourselves now for it. So I'm going to just box that up now, and we're going to look at it in a moment. The warranty provision relates to future repairs and is charged to operating expenses. Do you remember we had warranties here? Can you see warranties? This is warranty provision. So it's 180, but this time around it has been increased to 1,000 in that particular case. So 180, it has been increased to 1,000. Now, warranty is a non-cash item. So if it has increased, we would have to adjust for it as well in the financial statement. So I go back to my cash flow, and let's see if we can do some adjustments on that. So increase in warranty, that's 1,000 minus the last year figure 180, because that adjustment had been accounted for in the P&L, so we have to reverse it. And that is 820. It's a non-cash item, so we're going to add it back to the financial statement for the period under review. Then we will come back to the rest of the items. During the year, 20% convertible loan note holders exercise their right to convert to ordinary shares. Okay, we'll come back to this also because it's about the financing activities. So it means that we can go back and then finish up with our various issues here when it comes to the various workings we had. So it means in the context of the profit or loss on the disposal, we are going to get 10,500. Uh-oh. 10,500. 10,500. So it means there is loss on disposal. Okay, there is loss on disposal. And that is 1,500. Now, that loss on disposal was added to operating expenses, so it reduced the profit for the year. So what do we have to do if we are going to prepare our operating activities? We add it back. So loss on disposal. And that's from workings 3, 1,500. We add it back. Okay. Then we need the depreciation for the year. So it means we can close our accounts up relating to what we have here when it comes to the depreciation for the period under review. So we can close this account up. Let's see which side is bigger. Definitely the balancing figure has to be on the credit side. So 43, 9, and 2, and that is 54,000. So 54,000. 54,000, so that the balancing figure becomes charge for the year, and that is 6,000, I guess. So that was the depreciation for the year. Okay, 6,000. So that's what we bring to the operating activities and add it back from workings to 6,000. I hope you're getting the context of this question because um, you're not giving depreciation directly. You have to figure it out for yourself for the period under review. For the period under review. Then we go to our PPE account to see what is happening on the PPE. Since the information is all this, we can put them up. That should be credit side is more than the debit side. So that will be 103,500. 103,500. So it means the balancing figure will be acquisition, which will go into investing activity. Sounds good? So that is 103,500 minus 83,000, and that is 2,500. That will go into investing activities. Okay. Now I am still under um cash flow from operating though, but because I can have a space here, I can slash in from investing activities, and we bring in the purchases of non-current assets. You make sure you write that in full. That is 2,500. That's an outflow. All right. That's an outflow. So these are the adjustments that we do. But certainly you're not done with the workings because you have to deal with tax. So income tax, let's work for the tax account real quick. Go to the statements of financial position, then we're going to pick our items up. Now you have to be careful if you have both current and non-current. Let's keep this place a little bit clean because we will come back to it. So this is our information about tax under the current. In the non-current, we don't have deferred tax. This is non-current, but we don't have deferred tax relating to the non-current, so there is no problem. So it means our focus will just be on the current for the period under review. So last year is 5,300. So balance brought forward 5,300. Then we bring in the current figure, and that is 3,000. Okay. Then you go to the P&L account to see how much tax was charged for the year in the P&L. So let's clean this up. In the P&L, income tax expense is 3,200. That will come here, charge for the year. 3,200. Then you want to check the OCI because there could be tax in relation to the OCI when there is revaluation of assets. But in the context of this question, in the OCI, there is no tax. So we wouldn't bring anything in relation to it. So it means that is all. We balance this account, and that is 8,500 here, 8,500, so that the balancing figure becomes the tax paid for the year. And that is an amount of 5,500. Okay, that is the amount of 5,500. So that is the tax paid for the year. Any questions, you put it in the chat for me, then we can deal with the issue relating to that. Then we need to also find out the dividend that has been paid for the year. So workings 5. We will use retained earnings to catch the dividend that has been paid. Stay with me carefully. So we go to the statement of financial position and pick retained earnings. As you can see, retained earnings here is this figure 15,800 as against 19,800. So balance brought forward 15,800. So we close it up. Balance carry down 19,800. We go to the P&L account and find out the profit for the year. Okay, the profit for the year, and that is an amount of 7,000. If you can see that profit for the period, 7,000. So comes on the credit side. Profit for the year, 7,000. But if you remember, there was a statement the examiner made. So please stay with me carefully because we want to do something here. There was a statement the examiner made here. I'm going to clean these because I'll come back to it. I want us to pick a statement. He says, Coal Town, this statement, Coal Town makes annual reserves transfer from the revaluation surplus to the retained earnings. From the revaluation surplus to retained earnings. So the question is, if they make annual transfer, then we have to know how much transfer was made from the revaluation surplus to the retained earnings. Are you getting it? Because it means that if you should balance the retained earnings accounts right now, you will say, oh, the balancing figure is dividend paid, but you will be wrong because really there was some transfer from revaluation surplus to retained earnings. So how do you get the amount? So working 6, you want to prepare the revaluation surplus account so you know the transfer that came. So revaluation surplus So we go back to the statement of financial position and pick the revaluation surplus figure. There we go. Let me put it in the box. That is 2.5 and then 6.5. So balance brought forward 2,500. We close the account up 6,500. Okay. Then during the year there was a revaluation in the OCI, if you remember, gain on revaluation of 5,000. That's going to be brought. So revaluation during the year, that's in the OCI, 5,000. Then you balance this account up. Okay, so we're gonna have 7,500, 7,500. It means the balancing figure here is the transfer to retain earnings. That's the transfer we did to the retained earnings. Do you see how the transfer is being calculated here? You are in cash flow, so transfer to retained earnings. And that'll be, I think, 1,000. So this was the transfer that was taken to the retained earnings. So you debit the OCI, credit the retained earnings. You debit the revaluation surplus and credit retained earnings. So transfer from revaluation surplus, that's working 7 or 6 rather, and that is 1,000. So now you've dealt with that statement here that Coal Town makes annual reserves from revaluation surplus in respect of excess depreciation. So you now balance the accounts, then you will know the dividend paid for the year. And so 15,888, that's going to be 23,800. 23,800. The balancing figure becomes dividend paid. All right. And that is 19.8. That is 4,000. So that's the dividend paid. All right. Any questions, you put it in the chat for us, and I'll provide you with some answers in that case. So that's how we calculate our dividend paid. And we're going to take that to the either operating activity or financing activity. Dividend paid, I mean, it's your call. You can decide where you want to put it for the period under review. You can decide where you want to put it for the period under review. Then, so let's finish up with the workings, then we can go back and extract the financial statement and finish up with the financial statement. So remember I told you that in the share capital situation, there is a huge increase in the share capital. So we want to check the share capital and find out what exactly is going on with the share capital for the period under review. And then there is other components of equity also going up. Now, other components of equity could also mean share premium. Okay, but let's see, because the movement in these two accounts would have to be worked for. So we go to working 7, share capital. So we bring in the opening balance. So balance brought forward is 6,000. We close the account and we bring in the closing balance. And that is an amount of 16,600. All right, 16,600. But we need to find out what exactly went on for the period under review, because there was a note about the fact that some convertible loan notes changed. So look at what is happening here. It says during the year, 20% convertible loan note holders exercise their rights to convert their shares. So if you go back to the statement of financial position, that is why you see convertible loan notes, that there was a figure last year, 2000, but now there is no figure. So last year there was 2000, but now it is nil. Why? It is not because we have repaid them, it is because they converted. It's because they converted. Now, how much did they convert that to? The information will be given to us by the examiner. Oh, I scrolled too much. Okay, yeah. It says that the terms of conversion were 25 ordinary shares of $1 for each $100 convertible loan note. The remainder were paid in cash. Ignore any transfer from other component to retain earnings in respect of the redemption of the loan notes. Okay, so it means that the amount we owe was 2000. So to make the workings flow a little bit, I'm going to do workings 8, and that will be the 20% convertible or not. Okay, so let's bring that up as well. And we're going to just balance this account up. The opening balance was 2000. If you remember, 2000 there. Then let's go back and pick the conversion policy. They said you get 25 $1 share for every $100 bond. Okay, 25 $1 share for every $100 bond. All right, so what is coming here in that particular case? So if we owe the people 2000, how many shares are they going to get? If we owe the people 2000, how many shares are they actually going to be getting in that particular case? How many shares do you think they will get? So let's go and let's do that workings somewhere here. So number of shares would simply be the $2,000 over $100 times 25. Sounds good. So we can even just get the value. Let's go and get a value straight. So nominal value of shares. So we can multiply that by a dollar. Okay, because for every $100 bond, you get 25 shares. I hope you are getting the treatment. For every $100 bond, you get 25 shares. So if we work it out, what is going to happen is that 20,000, 2,000 divided by 100 by 25 by 1, and that is going to give us an amount of 25 for each $100. Okay, so that is going to give us an amount of $500. Okay, I'm seeing a chart coming in. Let's see if I can pick them up since they relate to something. When we are balancing the T account, do we look at the higher amount before finding the balancing figure? Yeah, the higher amount becomes the basis for the balancing. The side that is bigger becomes the basis for your balancing, and that is how you're going to be having the issue relating to that. Are you getting it? The higher amount is going to be coming in for that. Okay. So you use the higher amount to balance off the two places, and then you are going to have your issue coming in there. Going to have the issue coming in there. Then Rodwell said, thanks for this, but because of coming late. Can you post the video? Yeah, the video will be available. Is there any easiest way that we can get your book in Nigeria? We need it, sir. Yes, you can send us a WhatsApp message. Delivery can be arranged for you to get the book. +233 050 114 9296. So you can send her on WhatsApp on this number, and you'll be able to uh, get the book in that case. Be able to get a book in that case. And then, can I be part of your mentorship, Calvin from Sierra Leone? Yes, you can. You can send message to that number. Send a message on WhatsApp to that number, and definitely you will be assisted in that case. All right. So that is it there. Let me know if there are any other questions. Then we can continue. Okay, so let's go back. So, what are we saying here? The 20% loan note they exercise, and we are told that the remainder was settled in an amount relating to cash. And it says ignore any transfer from other components of equity to retain earnings in respect of redemption of loan notes. In respect of redemption of loan notes. So this is what we're going to do here in relation to what is happening there. So 500, they're going to get 500 for the conversion. But remember, that is not how much we owe them. That is not how much we owe them. We owe them 2,000. We owe them 2,000. So what is going to happen is that, again, if you look at it, it says that the terms of the conversion were 25 ordinary shares of $1 each for each $100 convertible loan notes. Okay, so that is why we did 2,000 over 100 by 25 by 1. So if we go back here, we have our convertible loan notes, and then we have our share capital. So I'm going to go to workings 9 and pull up the other components of equity. Then we'll balance the three together, because the loan notes relate to the three items. So other components of equity. Let's bring it up here. So we bring in the opening balance here. And other component of equity is 500 last year. Okay. But when we balance it now, the closing balance is an amount of 4,800. It's an amount of 4,800 here. So we're going to be completing the entries relating to the other components of equity as well. So let's go and then let's finish up. So our convertible loan note, we are going to transfer an amount of it for the period under review, and then we'll see the amount that is outstanding. So conversion, that will be share capital. So the amount that is going to share capital based on the workings here, it's 500. And that will be credited to share capital in the name of 20% ordinary share. Sorry, 20% convertible or not. 500. Okay. Now, remaining an amount of 1,005. And certainly that was paid in cash. So that will be going into financing activity later on in our cash flow as repayment. Okay, we'll go to our cash flow as repayment. I'm seeing a chart coming up. I need more explanation on 500 debited in profit or loss on disposal. Which 500 was debited in profit or loss on disposal? We didn't debit profit or loss with any 500 on disposal. The disposal amount was 1,500. Was 1,500, and that 1,500 came in from the disposal account we prepared in workings 3. Asset cost 10,000, had an accumulated depreciation of 9,000. We spent an additional 500 in disposing of the asset for the period under review, for disposing of the asset for the period under review. Then certainly the balancing figure was 1,005. So it's a loss because we were not having any proceeds from the disposal. It means there was no issue about proceeds from the disposal in that particular case. Let me know if that is okay for you. How can I get the book in Liberia? You can send her on WhatsApp. Details will be sent if it is possible to arrange delivery. If not, the books can also be procured directly on Amazon, and delivery will be done for you anywhere you are located. So if you hit Amazon, you just search for Nhyira Premium, and you will see my profile there, and you will be able to see all my books on Amazon. So if you go to Amazon, whatever, Amazon.co or Amazon.uk, all the marketplaces, you search for Nhyira Premium like this. And there you go with my profile. Okay, that is our podcast coming in. So we could pick it up there, and you will see. Okay, so this is the podcast. So let me go back up, and then let's look at books. There you go. So you can see my books as well. If you check my profile. Okay, so this is my profile on Amazon, and you can get a book on Amazon if you want to get both the Kindle version and then the copy. You'll be able to get all the books relating to that. So you can get it directly on Amazon, or you can send her on WhatsApp. If it is possible for us to arrange delivery for you, we'll be able to do that as well. Okay. Um, Zamzilu, let me know if the explanation to your disposal issue it's okay for you there. So we finish up, and then we look at the balancing figure. Let's go finish up. So with a share issue, we balance the account. The balancing figure will become issue of shares. Okay, the balancing figure will become issues of shares. So 16,600, 16,600. We pretend to balance it up, and that will give us the issue of shares. Okay, and that is going to be what? 16,600 minus 6,500. That is 10,100. So that is 10,100, and that is going to be issue of shares relating to that. Then we've already balanced this. This will go to financing activity later on in our workings. So we can now finish up with the various adjustments for the free marks that we need to get here, and then finish up with the operating activities for the period under review. So now in the statement of financial position, under current liabilities, we don't have interest owings. What it means is that the interest charged for the year is the same as the interest paid for the year under review. So we can get the adjustments coming in of the totals here. Then we can look at the current assets movement. So back up, inventory is going up. Okay, so we bring it in, increase in inventory. So increase in inventory, that's gonna be an amount of 5 200 400. All right. So we punch that out, and that gives us an amount of 800. Since it is increasing, cash is going out. Okay. Next one, trade receivables is also going up. So increase in trade receivables, and that is an amount of 800 minus 2 800, and that is 5,000. And that is also an outflow because money is going out, isn't it? Next one, bank. Don't worry, we will come to that later on. Trade payables, it's reducing. Now, when your trade payable is reducing, again, it is money going out. So decrease in trade payables. It's reducing slightly, and that is 4542. And that is the difference of 300. It means we are paying our debtors, sorry, our creditors for the period under review. Then the next thing is about negligence claim. The negligence claim here. So negligent claim 120. And the information about that was in note 3, which we read. We're told that in 2019, Coal Town made an out of court settlement. They have done a 2-year provision for this, and now the final settlement was made at 30,000. The final settlement was made at 30,000, and then they put it under operating activity. So if the final settlement was made at 30,000 and they put it under operating activity, it means that we need to bring it up for the period under review. And so that is going to be how much is it? Negligence claim, which was provided for previously. So negligence claim previously provided, and that is going to be the 120 coming up there for the period under review as well. Then I think the warranty, we've already dealt with it. So again, we can get arithmetics coming up, and that will give us cash generated from operations. Then we're going to punch it out. Then we bring in the interest paid for the year. Like I said earlier, because the um, there is no finance cost or interest owings in the statement of financial position, the finance cost will be the same as how much that was paid. So we'll just bring that 600 up again as a subtraction. Then income tax paid. I think we did a workings for that, so we can go pick it up. Income tax, that's workings for, and that was 500. So we bring it up. 5,500. And that is income tax paid. All right. That is income tax paid. So we add the arithmetics up so that we can get the total figures coming in for the period under review. Then that will give us the cash generated from operating activities. Net cash flows from operating activities. Net cash flow from operating activities. So that is the issue about that. And you're going to add up the arithmetics, and then you should get your final answer for the net cash flow from operating activities in that particular case. And so that is going to be an amount of 6,800. You can work that out to get your arithmetic figure there. I don't have time punching it out individually. So she gets 6,800 as a positive figure. So that is our net cash flow from operating activity. From operating activity. Remember, I mentioned the dividend can be here or can be under the financing activity. All right. So in the investing activities, what we have is the purchases of the asset. We bring that up for the period under review. But remember that when we're looking at the disposal of assets, the company paid 500 as part of the cost of disposing the asset. So that additional cost they pay on the disposal must come in the investing activity because it's a cash outflow. It's a cash outflow. So that's 500. That's going to come. Now, I think that is all. We are not going to have any issue relating to other forms of asset. They don't have any financial investment. There was no grant they received during the year. So it happens that on the investing activities, these are the only thing we have, and that is going to be an amount of 21,000 negative, and that is net cash flows from operating activity, sorry, from financing activities. From financing activities for the period under review. Then the next item there will be for the how do we call it? Cash flow from financing. From financing activities. So I won't forget, we will bring in the dividend paid. If you remember, we did a workings for that, and dividend paid. That's workings 5. We got 4,000. We got 4,000. Now that's an outflow because you are paying dividend. You are paying dividend. Then the convertible loan notes that we paid for, that we did workings for, if you remember, convertible loan notes 1,005. It's gonna be coming up. You paid for that, so that is an outflow for the period under review. Then we look at the issue of shares that we had. So issue of shares, we had a share capital of 10,100 coming in for the period under review. 10,100. But then the other component of equity, we have to balance it up because there was an information about it. Let's see if we can. Whoa, whoa, whoa. The time is almost up. I gotta go. Let's see if I can finish with this real quick. So during the year, 20% convertible or not, it says ignore any transfer from other component of equity to retain earnings in respect of the amount relating to the item here. So the question we ask ourselves is, what is going on when it comes to the issue relating to this other component of equity? So what we do is that there is no other information happening relating to the other component of equity. So we're going to have 5,800, 4,800 rather. Then we will have the balancing figure coming in as the benefits from the issue of shares. And that will give us an amount of 4,300 here. So that will be added to the amount here. And it gives us the total issue of share for the period. Because like I said, in the context of this question, we will take the other component of equity as though it's a share premium situation, because there was no information about it. So the best thing that we can assume it to be will be the issue relating to uh you know share premium. So 10,100 plus 4,300, and that is going to be an amount of 14,400. And that is issue of share. It's an inflow that is coming in into the organization. Then let's see if there is any other thing. Now there was 10% loan notes. The figure went up a little bit by 1,000. The 10% loan notes, it means we issued shares during the year. Issue loan notes. So issue of 10% loan notes. The difference was 1,000. That's an inflow for us as an organization or as an institution in that particular case. So we add it up arithmetically. So 4 minus 4 minus 1.5 plus 14.4 plus 1. And that's going to give us an amount of 9,900. Okay, 9,900 positive. And that is the net cash flow from financing activities. From financing activities. Okay, so what then do we have in that particular case? We add the three results up, the 6,800 from the operating activity. Okay, we add that to the 21,000 from the financing activity, then 9,900 from the operating activity, and that is an amount of, so 6,800 minus 21,000 plus 9,900, and that is 4,300 negative. So that will be net decrease in cash and cash equivalents. Net decrease in cash and cash equivalents for 300. Then we bring the cash and cash equivalents at the beginning of the year, which will go to the statement of financial position. Last year it was 700. So you bring it up 700 there for the period under review. And that should give us the closing balance brought down. And that is the closing balance 3,600. It's bank overdraft. So it's negative 3,600 negative. So that is our cash flow statement, and boom, it has balance. That is our cash flow statement, and it has balance. So that is how we deal with this particular question when it comes to the issue about cash flow statements. Now, as you can see, there are a couple of workings that went on, and then a couple of notes that were treated. And this is really a question in its own right, and you have to know how you are structuring the thing out relating to the workings about this. So this is the issue we must understand about a cash flow statement. And I'm going to be concluding around here today, and that brings us to the end of our discussion on the cash flow statement. Possibly later on, we're going to be, taking questions if it is possible for us to look at another question again. Fine, we could look at that. But that is cash flow statement. That is cash flow statement. Any questions? I'm going to be, concluding around here. My time is already up. I have management accounting lectures in a few minutes. It's like 4 minutes from now. So I'm ending here, and I'll catch you on Friday as we continue with something else in our discussion. And we will be looking at some of the topics that we've received, and then we would take something like that on Friday, God willing. So join me on Friday at 4:30 p.m. and then we can continue with our discussion. Remember, you can download our mobile application, the Nhyira Premium application, get access to some of the exclusive contents all in one on the app, and also get access to some notes that will assist you to prepare for the exams. It is also in the app that you can enroll in our courses or visit our website for more details on that. So that's it about that. Thanks for joining us on the stream, and I'll catch you on Friday. Stay safe and bye bye.